The constant growth residual income model extends the residual income valuation framework by assuming that residual income grows at a stable and perpetual rate. Similar to the Gordon growth model used in dividend valuation, this approach values a stock as the sum of its current book value and the present value of all future residual income expected to grow indefinitely. The model is most appropriate for mature companies with stable profitability, predictable growth prospects, and consistent returns on equity. By focusing on economic profit rather than dividends or free cash flow, the model provides a direct link between shareholder value creation and a company's ability to earn returns above its cost of equity. The primary drivers of value in the constant growth residual income model are return on equity, ROE, the required return on equity, book value, and the growth rate of residual income. Positive residual income is generated when ROE exceeds the required return, creating value above the company's book value. The larger the spread between ROE and the cost of equity, the greater the residual income and intrinsic value. Growth assumptions also play an important role because future residual income contributes to valuation. Consequently, analysts must carefully assess the sustainability of competitive advantages, profitability, and growth opportunities when applying the model to estimate intrinsic value. The constant growth residual income model can also be used to estimate implied market expectations. Given a company's current market price, book value, and required return on equity, analysts can solve for the growth rate implied by the market valuation. This implied growth rate provides insight into investor expectations regarding future profitability and value creation. If an analyst's forecasted growth rate exceeds the market implied rate, the stock may be undervalued. Conversely, if market expectations appear overly optimistic relative to realistic forecasts, the stock may be overvalued. This application makes the model useful not only for valuation but also for market expectation analysis. Continuing residual income. In practice, analysts rarely forecast residual income indefinitely. Instead, they project residual income over a finite forecast horizon and then estimate continuing residual income, which represents the value of residual income generated beyond the explicit forecast period. Continuing residual income serves a role similar to terminal value in dividend discount and free cash flow models. Because future forecasts become increasingly uncertain over time, simplifying assumptions regarding long-term profitability and growth are necessary. The present value of continuing residual income is then added to the present value of forecast period residual income and current book value to estimate the stock's intrinsic value. A key concept in estimating continuing residual income is the persistence factor, which measures the extent to which abnormal profitability is expected to continue in the future. If residual income is expected to remain indefinitely at its current level, the persistence factor equals 1. If competitive pressures are expected to eliminate abnormal profits immediately, the factor equals 0. Most companies fall between these extremes because excess returns gradually decline as competition erodes economic advantages. Analysts therefore evaluate industry conditions, barriers to entry, brand strength, intellectual property, and management effectiveness when determining how persistent future residual income is likely to be. Another approach to estimating continuing residual income involves assuming that a company's profitability eventually converges toward a normal long-term level consistent with industry maturity. Under this assumption, excess returns gradually disappear as competition drives ROE closer to the cost of equity. This method is often more realistic because economic theory suggests that sustainable abnormal profits attract competitors over time. The estimation of continuing residual income, therefore, requires a careful assessment of competitive advantages and industry dynamics. Since continuing value frequently represents a substantial portion of intrinsic value, reasonable long-term assumptions are critical for producing reliable and defensible valuation estimates. Strengths and weaknesses. Residual income models offer several important strengths. They are particularly useful for firms that do not pay dividends, companies with negative free cash flows, or businesses experiencing temporary financial volatility. Because the valuation begins with current book value, terminal value estimates generally have less influence on intrinsic value than in dividend discount or free cash flow models. Residual income models also rely on accounting information that is readily available and focus directly on economic profitability by incorporating the cost of equity capital. These characteristics make the approach valuable when traditional cash flow-based valuation methods are difficult to apply effectively. Despite their advantages, residual income models have limitations. The approach relies heavily on accounting data, which may be influenced by management discretion, accounting policies, and earnings manipulation. Significant adjustments may be required to ensure consistency with economic reality. The model also assumes compliance with a clean surplus relationship, meaning that changes in book value are properly reflected through earnings and dividends. Violations of this assumption, valuation challenges involving intangible assets, non-recurring items, aggressive accounting practices, and international accounting differences can reduce reliability. Therefore, analysts must carefully evaluate financial statement quality and make appropriate adjustments before applying residual income valuation techniques. Private company basics. Private company valuation differs from public company valuation because private firms lack readily observable market prices and often operate under different ownership, governance, and reporting structures. Public companies benefit from active trading markets, transparent financial disclosures, and broad investor participation, while private firms typically have concentrated ownership and limited information availability. As a result, analysts must make additional assumptions regarding liquidity, risk, and financial performance. Private company valuation is commonly used for mergers and acquisitions, estate planning, taxation, litigation support, employee stock ownership plans, and strategic decision-making. Understanding these unique characteristics is essential for producing reliable and defensible valuation estimates. A major challenge in private company valuation is estimating normalized earnings and cash flows. Private firms often include discretionary expenses, owner compensation adjustments, non-recurring items, and personal expenditures that may not reflect the company's true economic performance. Analysts therefore adjust reported financial statements to estimate sustainable operating results. Normalized earnings provide a more realistic basis for forecasting future cash flows and determining intrinsic value. In addition, private companies may have limited historical data, less rigorous reporting standards, and greater dependence on key individuals. These factors require analysts to exercise professional judgment when evaluating financial performance and future growth prospects. Discount rate. Estimating the appropriate discount rate is one of the most important aspects of private company valuation. Unlike public firms, private companies often lack observable market data such as stock prices and beta estimates. Consequently, analysts must adjust traditional valuation techniques to reflect the unique risks associated with private ownership. These risks may include limited liquidity, customer concentration, key person dependence, smaller operating scale, and restricted access to capital markets. Because discount rates directly affect present value calculations, even small changes in required returns can produce significant differences in estimated company value. Accurate risk assessment is therefore critical to the valuation process. Several approaches can be used to estimate the cost of equity for private companies. The Capital Asset Pricing Model, CAPM, is appropriate when comparable public firms exist and reliable market data are available. The expanded CAPM extends the traditional model by incorporating additional premiums for firm-specific risk. When comparable public companies are unavailable, analysts frequently use the build-up method, which estimates the required return by combining the risk-free rate, equity risk premium, size premium, and company-specific risk premium. Each method attempts to capture the additional uncertainties associated with private ownership while providing a reasonable estimate of investor return requirements. Private company valuations often require adjustments for control and marketability. A control premium reflects the additional value associated with obtaining decision-making authority over a business, including the ability to influence strategy, dividend policy, and operations. Conversely, minority interests may warrant a discount for lack of control, DLOC. Analysts may also apply a discount for lack of marketability, DLOM, because private company shares cannot be easily sold in public markets. Factors affecting DLOM include company size, liquidity, expected holding period, financial stability, and the potential for future public offerings. These adjustments significantly influence valuation outcomes and transaction pricing. Valuation. Private company valuation generally relies on three major approaches: the income approach, the market approach, and the asset-based approach. The income approach estimates value as the present value of expected future cash flows and is conceptually similar to discounted cash flow valuation used for public companies. The market approach derives value from multiples observed in comparable company transactions or public market comparables. The asset-based approach values a business by estimating the fair value of its assets and subtracting liabilities. Each approach has advantages and limitations, and analysts often use multiple methods to improve reliability and validate valuation conclusions. The selection of an appropriate valuation method depends largely on a company's life cycle stage, operating characteristics, and available information. Early-stage firms often have uncertain future cash flows, making the asset-based approach more appropriate. High-growth companies are frequently valued using income-based methods because future cash flow generation is the primary source of value. Mature businesses with stable operations and abundant comparable transaction data may be well suited to market-based valuation approaches. Firm size, industry characteristics, financial condition, and ownership structure also influence methodology selection. Analysts must align the chosen valuation technique with the economic realities of the business being valued. Successful private company valuation requires integrating cash flow forecasting, discount rate estimation, and appropriate valuation adjustments into a consistent analytical framework. Analysts must carefully evaluate normalized earnings, growth opportunities, capital structure, risk factors, and transaction-specific considerations. Because private firms lack observable market prices, valuation uncertainty is often greater than for public companies. Therefore, professional analysts frequently compare results across multiple valuation approaches and perform sensitivity analyses to assess the impact of key assumptions. By combining sound financial analysis with informed judgment, analysts can develop credible estimates of private company value that support investment decisions, acquisitions, financing transactions, and strategic planning activities.